So you work from home, maybe you're a freelancer, and you've definitely heard about the home office deduction, right? It's one of the most popular tax breaks out there. But what if I told you that sweet little deduction has a hidden sting in its tail, one that could cost you thousands of dollars years down the road when you sell your house? Yeah, let's get into it.
I mean, the appeal is obvious, isn't it? You carve out a little space in your home for work, you deduct a chunk of your expenses, and just like that, poof, your tax bill shrinks. It really feels like a total no-brainer. But, and there's always a but with taxes, right? This is where things get a little tricky. That yearly tax break you've been enjoying, it can actually set you up for a nasty surprise tax bill years later. It's kind of like the IRS gives with one hand, only to take it back with the other. All right, so before we get to the scary stuff, let's talk about why everyone loves this deduction in the first place. What makes it so popular?
Well, the perks are immediate and they are very real. You get to deduct a portion of things you're already paying for, like your mortgage interest, utilities, insurance. All of that directly lowers the amount of income you have to pay taxes on. And what does that mean? A smaller income tax bill. And hey, if you're self-employed, it can also knock down your self-employment taxes. So yeah, it's a really powerful way to save some serious cash right now.
Okay, so here it is, the catch, the thing that nobody really talks about, this little complication. It doesn't show up on your yearly tax returns. Nope, it just kind of waits silently, all the way until the day you decide to sell your home. So check this out. Normally, when you sell your main home, there's this huge tax break. You can make up to $250,000 in profit or even $500,000 if you're married and pay zero tax on it. Pretty sweet. But the moment you claim a home office, the IRS looks at that little corner of your house differently. Suddenly, it's not just your home anymore, it's business property. And guess what? Business property plays by a whole different and much less friendly set of tax rules. And the key to this whole thing, the good and the bad, is a concept called depreciation. Just think of it like this. The IRS lets you take a tax break for the wear and tear on the business part of your home over time. So every year you claim that home office, you also get to claim a little bit for depreciation. It saves you money in the short term, for sure. But it's also the very thing that creates the problem later on. Okay, so this is absolutely crucial. Every single dollar of depreciation you claim actually reduces what the IRS calls your home's cost basis. Now, in plain English, that just means it makes it look like you paid less for your house than you really did. So when you go to sell it, the gap between what you sell it for and this new artificially lower cost, well, that gap is bigger. And to the IRS, a bigger gap means a bigger profit. And that brings us to the main event, something with the ominous-sounding name depreciation recapture. And honestly, it's exactly what it sounds like. It's the way the IRS recaptures, or, takes back all those tax benefits you got from depreciation over the years. Okay, the super technical term for this is unrecaptured Section 125 gain. I know, it's a mouthful, but don't let the name scare you. All it really means is the grand total of all the depreciation you've claimed on your home office. That's it. This specific number gets pulled out from your total profit on the sale and is taxed completely on its own.
And it gets taxed at a very specific rate, 25%.
Yeah, this special 25% rate is specifically for that recaptured depreciation amount. And here's the kicker. It doesn't matter what your normal tax bracket is. It doesn't even matter if the rest of your profit from selling your house is totally tax-free under that big exclusion. That chunk of money from depreciation, it gets hit with a flat 25% tax, no exceptions. Just to put that into perspective for you, most long-term capital gains, like profits from stocks, are taxed at around 15%, sometimes even lower. This depreciation recapture tax is a whole different beast, a flat 25%. That is a significant difference. Okay, deep breath. If you only remember one thing from this whole explainer, please make it this next part. We're about to get to the most shocking and potentially most costly rule in this entire home office deduction maze. Right now, you're probably thinking, okay, I get it. I see the trap, so I'll just be smart about it. I'll claim the home office expenses, sure, but I'll just, skip the depreciation part. That way I avoid the 25% tax later. It's a perfectly logical thought. But the IRS is about a million steps ahead of you. This right here, This is the exact phrase from the IRS that springs the trap. The rule applies to depreciation that is either allowed or allowable. See that word, allowable? That's the one that gets you.
Because what the IRS is saying is, it doesn't matter. You owe the tax anyway.
Let's be crystal clear about what this means. Even if you never claimed a single penny of depreciation on your tax returns, if you were entitled to take it, the IRS basically assumes that you did. So when you sell your house, you will owe that 25% tax on the amount you could have and should have claimed. You can't just opt out of the consequence by not taking the benefit. It's a really tough rule, but that's how it works.
So after all of that, the big question is this deduction even worth it? Well, let's stop talking theory and run through a quick real-world example to see how it all shakes out.
All right, let's imagine this. Over, say, 10 years, you claim a total of $10,000 in depreciation for your home office. And each year, that saves you a little bit of money on your taxes, which is great. Now, fast forward. You sell your house. Your total profit is well under the tax-free limit, so you're thinking, awesome, I owe zero tax. But the IRS looks back, sees that $10,000 in depreciation you claimed, and says, aha, time to recapture that.
And the results? Out of nowhere, you get a tax bill for $2,500. That's 25% of the $10,000 in depreciation, and you have to pay it, even if every other penny of profit from the sale is completely tax-free. Okay, so let's tie this all together. The big thing to remember is that the depreciation part of the home office deduction is really a tax deferral, not a tax deletion. You're basically getting a loan from the IRS that you have to pay back later. And because of that tricky allowed or allowable rule, you can't get out of it. And just a quick tip, a home office depreciates over 39 years. But look, this doesn't automatically mean the deduction is a bad idea. For many people, the yearly tax savings are still totally worth more than the final tax bill. You just have to do the math. So the real question is, knowing the true cost now, is this the right move for you? It really depends. Think about it. How long are you planning to be in your home? The longer you claim it, the bigger that future tax bill gets. Also, what's your tax situation like now compared to what it might be when you sell? Maybe saving a bunch of money today when your income is high is worth paying a bill later on. The bottom line is the home office deduction can be a fantastic tool, but only if you go in with your eyes wide open, understand the full picture, and decide if it truly fits your financial plan.